In Chapter 2, we look at job costing examples and how we allocate costs to individual jobs. So in this example, we're going to look at allocating costs to jobs using two different methods of overhead allocation. The first example we're going to look at is single plant-wide overhead allocation. So we have one rate for allocating overhead to all jobs throughout a period. Then we're going to look at the same exact example with two overhead rates or departmental overhead rates and look at how the change from one rate to two rates changes everything from our total product cost to per unit product cost to the sales price that we charge for items. So we have information about this company, and it tells us that we have two manufacturing departments, molding and fabrication, and we had two jobs started and completed in March, Job P and Job Q. We had no under or over applied manufacturing overhead costs during the month. We're going to deal more with under and over manufacturing overhead during Chapter 3. So we're going to work through each one of these questions. Question 1, what is the predetermined overhead rate? So in order to calculate that, we have to find our total estimated overhead. So we take the information that we have about costs and we put that into our linear equation. So we need to determine what the overhead is for each department, and then we can add up our overhead for costs. So when we're looking at the molding department, we have fixed cost of $10,000, variable cost of $1.40, and total machine hours of 2,500 estimated for the year. So remember that overhead allocation, or that our linear equation is fixed cost plus variable cost times the number of machine hours or direct labor hours or units or whatever we use equals total cost. 10,000 in fixed cost plus $1.40 in variable overhead times 2,500 in machine hours. Make these bigger so you can see the full equation. And for fabrication, that would be our fixed cost of 15,000 plus our variable cost of $2.20 times 1,500 hours. So if we let Excel do that math for us, we take the fixed cost plus our variable cost times the number of machine hours. Fixed cost plus variable cost times number of machine hours. We add these together and we have our total estimated overhead costs for the period. To get our predetermined overhead rate, we take our total costs, 31,800, divided by the total number of estimated machine hours, or 4,000. So our rate is $7.95 per machine hour. That's our predetermined overhead rate. The next thing we want to do is apply manufacturing overhead to each job. So we have job P and job Q. We have a rate of $7.95 per machine hour. We take that times the number of machine hours in each job. So we see here that job P used 2,300 machine hours and job Q used 1,700 machine hours. So for job P, we take 2,300 machine hours times our rate of $7.95 per machine hour. And for job Q, 1,700 hours times our rate of $7.95 per hour. We then add up those costs direct materials, direct labor, and the allocated overhead. And we're given the total cost per job. So job P was $52,285 and job Q is $29,015. So that answers the next two questions. Then we want to know, what is the per unit cost of each job? I'm going to add in, so number of units and per unit cost here. So job P, it says we had 20 units. And for job Q, we had 30 units. Change that to a number from a dollar amount. Our per unit cost, take the total cost divided by the number of units. So we get a per unit cost for each job. Our next question says, assume that we use cost plus pricing and a markup of 80% to establish selling prices for all of our jobs. What is our selling price? So we have a markup of 80%. So in cost plus pricing, we take the total production cost, so our direct materials, labor, and overhead for each job, get our per unit cost. Then we add up a markup of some amount, 110%, 75%, 120%. It's almost always given to us as a percentage. So we take our total per unit cost times 80% or 0.8, and that gives us what our markup is for each product. We add the markup to our per unit cost, and that gives us our total selling price. The last question says, what is our cost of goods sold for March? So if you remember, cost of goods sold is our per unit cost times the number of units sold. So we have our per unit cost times the number of units sold equals our total cost for job P and job Q. So to calculate our cost of goods sold, we add the total of these two jobs together. So our cost of goods sold for March is $81,300. Now this is using a single plant-wide overhead rate. If we change the way we calculate overhead, our total and per unit costs for product costs will change based on the allocation method we use for overhead. So we're going to look at this same exact problem using departmental overhead rates. So using a different rate for molding and fabrication. So we go to our departmental rates. We have all of the same information. We want to know, what is the predetermined overhead rate in the molding department? So remember, we have to go back to that overhead calculation. It almost always goes back to that linear equation. Y equals A plus BX, as it is in the textbook. We take our fixed cost of 10,000 plus $1.40 times 2,500 hours. Or $13,500, which matches what we got when we did the same thing on the previous example. We then take that divided by the number of machine hours for the department, or 2,500. So we take our total divided by 2,500, and we get a rate of $5.40 per machine hour for the fabric molding department. We do the exact same thing for the fabrication department. We have fixed costs, 15,000, a variable cost of $2.20 per machine hour, and we have machine hours of 1,500. So look at this information. 15,000 fixed cost, $2.20 variable, 1,500 hours. We get $18,300 divided by 1,500 machine hours, and we get an allocation rate of $2.20 per machine hour for the fabrication department. Now when we apply to our jobs, we need to apply overhead for each department separately. So first we'll start with the molding department. We see that for the molding department, job P used 1,700 hours and job Q has 600 hours. So for job P in molding, we will take 1,700 hours times our rate of $5.40 per hour. And for job Q, we will take 600 hours times 600 hours times our rate of $5.40 per hour. For fabrication, we have 600 hours on job P and 900 hours on job Q, so fabrication. So for job P, we take 600 hours times our rate of $12.20 per machine hour. And for job Q, we take the hours of 900 machine hours times our $12.20 per machine hour. So now we've answered how much overhead was applied from the molding department to each job and how much overhead was applied from the fabrication department to each job. We add all of our costs together, direct materials plus direct labor plus overhead, and we get our total product costs. So we can already see that the total costs for each job are different than they were in our other example where we had allocation a single overhead rate. So we've changed the amount per job, which will then change our amount per unit. Number of units. We have 20 units for P and 30 units for Q. Cost per unit. We take the total cost of the job divided by the number of units. We add our 80% markup, take the cost per unit times 0.8 or 80%. We add our cost per unit plus the markup, and we have our selling price. So we can tell that the cost per unit and the selling price changes depending on our overhead allocation rate. So we can see that for job Q, the change was not that big. So $967 and some cents to $990 and some cents. Not that big of a change. The per unit cost on job P is a little bit more. So all told, we add 43 cents to the cost, or $43 to the cost per unit of your selling price per unit of job Q, and about $150 to the selling price of job P. So you can see how changing the way that we allocate overhead changes our total product costs. So as we talked about in the PowerPoint and in class, the more overhead rates that you use is considered the more accurate product costs you get. And we're going to talk more about multiple overhead rates in other chapters. So trying to determine how to allocate overhead is a major thing for businesses and organizations. One, because there's no set rule about how they should do it. They can have single rate, they can have 2 rates, they can have 10 rates, however they decide to do it. The only rule is that they can only include product costs. So they can't combine selling and administrative or period expenses into their manufacturing overhead costs and then spread all of those costs around. So that's a GAAP rule. The other rule is that they have to be consistent with what they're using. So if they use single plant-wide rate and then they decide to switch to departmental rates, they would disclose that in their financial statement and say that we have changed our method of overhead calculation, so our inventory calculations have changed, much like we would have done in Principles of Accounting 1 if we changed our inventory method from LIFO to FIFO. And then they need to remain consistent for a period of time with whichever method they use. They shouldn't be changing the way that they cost their products every month. As you can see, there is a manipulation possible with this. So if I want lower product costs or higher product costs, I can manipulate the way that I challenge my overhead to a certain extent. Again, where it comes into that gray area of how much of that manipulation is allowed and how much of that manipulation am I doing just to make my costs look different, to make my accounting records look different. We'll talk more about ethics next week in Chapter 3.